Hello everyone and welcome to this week's Click Trading Education Weekly Market Summary. I am Iftikhar Khan and over the next few minutes we'll look at what moved the financial markets during the week, ending the 17th of July, examine the major technical developments across the key asset classes and finish by looking ahead to the important economic events that could influence markets next week. As always, our objective isn't to predict where our aim is to understand why markets are moving, identify where opportunities may develop, and ensure we're prepared with a structured trading plan rather than reacting emotionally to headlines. So let's get started. Market overview. This week marked a noticeable shift in market sentiment. After several weeks of relatively constructive price action, investors became considerably more cautious, with risk appetite deteriorating throughout the week. The biggest casualty was the technology sector. The Nasdaq fell almost 4%, significantly underperforming the broader market as investors reduced exposure to high growth companies. The S&P 500 also finished lower, losing around 1.5%, while the Dow Jones proved slightly more resilient, declining by just under 1%. Interestingly, European markets told a slightly different story. The FTSE 100 actually finished the week higher, highlighting the different economic drivers currently influencing the UK compared with the United States. Away from equities, commodities produced a mixed picture. Crude oil surged almost 11%, making it one of the strongest performing major assets of the week. At the same time, precious metals struggled. Gold fell just over 2%, while silver experienced a much sharper decline of more than 5%. In the currency markets, the US dollar index weakened only marginally. However, beneath the surface, there were some meaningful movements, particularly against commodity-linked currencies, such as the Canadian dollar, supported by the sharp rise in oil prices. Cryptocurrency markets also showed mixed performance. Bitcoin remained relatively stable. Ethereum continued to outperform, while Solana came under significant selling pressure. Perhaps the most important development of the week came from volatility. The VIX, often referred to as Wall Street's fear gauge, rose by approximately 15%. Whenever we see volatility increase this sharply, it's a reminder that traders need to remain disciplined and respect their risk management. What stood out this week? Several moves deserve particular attention. Firstly, crude oil. Nearly an 11% rise in just 1 week is significant. The move was largely driven by supply concerns and ongoing geopolitical tensions affecting energy markets. Higher oil prices have implications well beyond the energy sector. They influence inflation expectations, transportation costs, manufacturing expenses, and ultimately central bank decision making. Secondly, the technology sector. The Nasdaq's sharp decline reflected growing concerns surrounding valuations and future earnings expectations. We've spoken many times about the importance of understanding market rotation. Markets rarely move uniformly. Capital constantly rotates between sectors, and this week investors clearly favoured more defensive positions over high-growth technology companies. One stock that bucked the trend was Apple, which gained more than 5% following strong earnings. On the opposite side, Tesla fell almost 6% as concerns around margins and increased competition weighed on investor sentiment. Meanwhile, silver experienced one of its weakest weeks for some time, reinforcing that even traditional safe haven assets don't always move in the same direction. What moved the markets? There were 3 major themes driving markets this week. The first was inflation. US inflation data showed some moderation, which initially encouraged investors. Normally, lower inflation increases the possibility of future interest rate cuts. However, that optimism faded fairly quickly. Instead of focusing purely on inflation, markets shifted their attention towards economic growth. Recent consumer sentiment figures suggested households are becoming increasingly cautious. Lower confidence can eventually translate into weaker spending, slower economic growth, and softer corporate earnings. So although inflation appeared encouraging on the surface, investors became more concerned about the broader economic outlook. The second major theme remains central banks. The Federal Reserve continued to adopt a cautious, data-dependent approach. Rather than committing to future interest rate changes, policymakers emphasised flexibility. We heard a similar message from the European Central Bank. While the Bank of Japan maintained its ultra-loose monetary policy, these differing approaches continue to create opportunities within the currency markets as traders assess interest rate differentials. Finally, geopolitical developments once again played an important role. Renewed tensions surrounding global energy supplies contributed significantly to oil's rally. At the same time, uncertainty surrounding international trade discussions added another layer of caution across financial markets. Technical market review. Let's now look at the charts from a technical perspective. Across the major US indices, the overall trend remains under pressure. The S&P 500 and Dow Jones are currently testing important support areas following recent declines. Momentum indicators suggest that sellers remain in control for now, although we're approaching zones where buyers could begin to show renewed interest. The Nasdaq continues to look particularly vulnerable. Price has broken below several important support levels, and traders will now be watching closely to see whether buyers defend the next major demand area. In commodities, crude oil remains firmly in an uptrend. However, after such a strong rally, traders should remain cautious of possible short-term profit-taking before the broader trend resumes. Gold and silver continue to weaken. Both markets have broken below recent support levels, suggesting momentum currently favours the downside. In the cryptocurrency market, Bitcoin remains relatively stable and continues to consolidate. Ethereum continues to show relative strength compared with many alternative cryptocurrencies, while Solana has underperformed considerably this week. Finally, in the foreign exchange markets, the US dollar remains mixed rather than showing a clear directional trend. Pairs such as USD-CAD have been heavily influenced by the sharp rise in oil prices, while UIUSD and GBPUSD have both benefited from modest dollar weakness. As always, we continue to focus on high-quality supply and demand zones rather than chasing markets after large moves. Looking ahead, next week brings another busy economic calendar. On Monday, attention turns to Chinese GDP figures. Given China's importance to the global economy, these numbers could influence commodities, currencies, and global equity markets. Tuesday sees US retail sales. Consumer spending remains one of the strongest indicators of economic health, making this an important release. On Wednesday, we'll receive UK inflation data. This will provide further clues regarding future Bank of England policy. Thursday's headline event is undoubtedly the European Central Bank interest rate decision. Markets will be watching not only the decision itself, but more importantly, the accompanying guidance regarding future policy. Finally, Friday rounds off the week with US PMI figures together with the latest Bank of Japan monetary policy announcement. Overall, traders should expect periods of increased volatility throughout the week, particularly around these scheduled economic releases. Key takeaways. So what are the main lessons from this week's market action? Firstly, rising volatility reminds us why risk management always comes first. No setup is worth risking your trading account. Secondly, we're seeing clear evidence of sector rotation. Leadership within the market constantly changes, and traders need to recognise where institutional money is flowing. Thirdly, oil continues to demonstrate how geopolitical developments can quickly influence financial markets. Fourth, central bank communication remains one of the biggest long-term drivers of currencies, bonds, and equities. Finally, remember that successful trading isn't about predicting every market move. It's about consistently following your trading plan, managing risk effectively, and only taking high-quality opportunities when your rules align. Outro. That's all for this week's market summary. If you found this video useful, please give it a like, subscribe to the channel, and turn on notifications so you don't miss our future market updates and educational content. You can also visit www.clicktradingeducation.com to learn more about our structured trading courses, live mentoring, and trader development programs. Until next week, trade safely, stay disciplined, and remember, it's not about predicting the markets, it's about having a process for responding to them. Thanks for watching, and we'll see you in the next video.